Welcome back to Talk Tickers. So imagine you own a successful legacy business right on Main Street.
Okay, like a classic retail shop.
Exactly. And for decades, the local traffic patterns basically guaranteed that thousands of people would walk past your storefront every single day.
Right, you've got that built-in foot traffic.
Yeah, and your entire business model, your staffing, your inventory, everything is built on the mathematical certainty of those people walking by. But then, over the course of just 2 years, the city decides to build a massive bypass highway.
Oh, wow. So they just reroute everyone.
They reroute the traffic entirely. Half the people who used to walk past your doors are simply gone. You lose 50% of your top-of-funnel customer base in 24 months.
I mean, the natural expectation there is a slow-motion car crash, right? You'd be laying people off, scrambling just to keep the lights on.
Exactly. But what if, despite losing half of your historical customer base, your revenue somehow went up by 14%?
Honestly, that defies the basic laws of retail or digital physics. You can't shrink the funnel by 50% and grow the yield by double digits without a total reinvention.
Right. You'd have to fundamentally alter what you're selling, how you're selling it, and who you're actually selling it to.
And that mathematical impossibility is exactly the reality we are unpacking today.
Yes, it is. Because today's mission on this deep dive is looking at the Q4 2025 earnings call transcript from IAC. Specifically, their digital media and internet properties.
Which is such a fascinating document. I mean, it's basically a real-time survival diary.
It really is. It's about a massive digital publisher navigating the total collapse of traditional Google search traffic and, the meteoric rise of generative AI.
And for anyone holding this stock or just watching the media landscape, you have to look at the raw data presented by Chairman Barry Diller and Neil Vogel. He's the CEO of their PeopleLink division.
Right. So let's start with the headline numbers, because this is where the bleed is obvious. The core web sessions across their digital properties dropped by 13% year over year.
13%. I mean, that is a massive drop in active users visiting their traditional websites.
Yeah, but the mechanism behind that drop is the really critical piece of context here. The transcript points to a staggering 50% decline in Google search referrals over the previous 2 years.
50%? That is just brutal. We are basically witnessing the end of the 10 blue links.
For sure. Because for a decade, digital publishing was essentially just a game of arbitrage, right?
Exactly. You figure out what people are searching for, you write an article targeting those exact keywords, and Google ranks you on page 1.
These are clicks, and you monetize that brief visit with display ads. But that entire ecosystem is being systematically dismantled.
Right, by things like Google Discover, which curates feeds directly on your phone without you even searching for anything.
And more importantly, by AI overviews. I mean, the AI overview is the kill shot for traditional publishing.
It really is. I notice this in my own behavior all the time now.
Same. Like, if I want to know the internal temperature for a medium rare steak, I don't want to click a link. I don't want to scroll past 3 paragraphs about the author's summer in Tuscany.
Right, and dodge a pop-up ad just to find the number 135 degrees.
Exactly. The AI simply extracts that number
Yeah.
and presents it at the very top of the search results.
So the user gets their answer instantly. The search journey ends right there, and the publisher gets 0 traffic.
0 ad impressions, 0 revenue. The AI is essentially strip mining the web for facts and disintermediating the actual creators.
What's fascinating here is how the leadership reacts to this. Because reading this transcript, there is no panic.
None at all. Instead, it's this calculated defiance. They managed to grow their digital revenue by 14%, which is wild.
And they did it because they anticipated this vulnerability long before ChatGPT was ever released to the public.
Yeah, the timeline they outline is crazy. Vogel notes that 5 years ago, 70% of their traffic came from Google search.
70%. That is an incredibly precarious position for any business.
They were essentially tenant farmers. They built this lucrative business, but it was all on Google's land.
Right, and Google could just raise the rent or change the algorithm at any moment, and the publisher would have absolutely 0 recourse.
And most publishers looked at that heavy concentration of Google traffic as a victory. They thought, hey, our SEO teams are winning.
But Vogel and Diller looked at that dependency and viewed it as an existential risk. They explicitly state in the call that they knew they were over-reliant.
They recognized that building a business entirely dependent on a single third-party distribution pipe was fundamentally flawed.
So they inoculated themselves. By treating Google like an unreliable partner years before the AI disruption actually hit, They forced their internal teams to develop different muscles.
They had to figure out how to generate revenue that wasn't strictly tied to a user typing a query into a search box.
And that early realization is exactly why they are surviving right now, while other legacy media brands are just folding.
Yeah, they absorbed the shock incrementally. Today, Google only accounts for about 30% of their traffic.
Which is a huge drop from 70. They diversified their exposure, and that gave them the breathing room to execute this radical transformation.
Okay, let's unpack this transformation, because this is where the transcript moves from defensive maneuvers to a highly aggressive offensive strategy.
Right, the beable strategy.
Yeah, in the call, Barry Diller gets noticeably animated when discussing a shift away from what he calls the daily grind of conventional digital publishing.
And they reference this internal framework, Diebel. The core philosophy is inverting the traditional content business into a standalone consumer product business.
Because the traditional model views content as the bait, right? You invest capital to produce an article to attract an audience.
And your actual customer is the advertiser who pays for access to that audience's attention. But Diller's strategy flips that entirely.
They're using their immense brand equity to create tangible physical products. The brand itself is what the consumer is purchasing directly.
And these aren't just hypothetical whiteboard concepts. They are active, capitalized initiatives. Take Southern Living, for example.
Right, an iconic magazine brand. The historical play would be to write endless articles about sweet tea to capture search traffic.
But instead, they are launching an actual, physical Southern tea product line.
They're managing the supply chain, the manufacturing, the distribution of a consumable good.
And as an investor, you have to analyze the defensive nature of that move. Generative AI is infinitely scalable in the digital realm.
Yeah, it can write 1 million articles about tea in 10 seconds at zero marginal cost.
Exactly. But AI cannot physically brew, bottle, and distribute a high-quality beverage.
No, it can't. By moving their monetization strategy from digital ads to physical consumer packaged goods, they are migrating to a battlefield where AI has absolutely no advantage.
They are leveraging their cultural clout, the trust consumers have in that Southern Living brand, to bypass the digital bloodbath entirely.
Okay, that makes logical sense. But manufacturing a physical product is a totally different core competency than publishing a magazine.
Oh, absolutely.
A media company suddenly trying to manage spoilage, warehouse logistics, and grocery store slotting fees. That seems incredibly risky.
The capital expenditure alone could wipe out the margins they're trying to protect.
Right, but that would only be true if they were building the supply chains from scratch.
Which a conglomerate of this size rarely does. They utilize licensing agreements and strategic partnerships.
They provide the brand authority, the marketing pipeline, and the audience data while partnering with established manufacturers who handle the physical logistics.
They are essentially renting out their consumer trust for a massive cut of the revenue. And we see this replicated across their other brands too.
Yeah, they mention food and wine, where they are organizing the best chefs globally into a brand new product line.
And the most ambitious one is travel and leisure. They have this massive archive of global destinations and incredible photography.
Diller specifically states they are going to create their own White Lotus experience. They are moving into luxury travel and real-world hospitality.
The economics of luxury travel offer such a stark contrast to digital publishing.
In publishing, you're fighting for pennies per 1,000 ad impressions.
Right, but in luxury hospitality, you are securing thousands of dollars per customer, per week.
And again, an AI chatbot can easily generate a 5-day itinerary for a trip to Sicily, but it cannot acquire the real estate.
It can't hire the staff or provide the visceral, high-end experience of a luxury resort.
They are taking the digital domain authority they built over decades and materializing it into experiential goods in the physical world.
But this brings up a major contradiction in their strategy that the transcript highlights.
Yeah, the print magazines. They are building this futuristic, AI-proof physical infrastructure. But Neil Vogel confirms they're still distributing around 350 million physical print magazines every single year.
They call them books internally. And maintaining a legacy print operation of that scale in 2025 has to be a massive capital drain.
Paper costs, postage, printing facilities. It seems completely at odds with an agile, forward-looking company.
It does appear contradictory until you analyze the modern economics of customer acquisition.
Right, the HET.
Exactly. Whether you are selling tea, luxury travel, or software, the single highest expense today is acquiring the customer.
You have to pay Meta, Google, or Amazon exorbitant rates to run targeted ads just to get a consumer to notice your new product.
The digital advertising duopoly extracts a massive toll from every new brand trying to enter the market.
So those 350 million magazines essentially act as a subsidy for that acquisition cost.
Precisely. Barry Diller points out the financial loop. Because they already have the infrastructure to print and ship those magazines, adding a few pages of promotional material costs them basically nothing.
It's a built-in, highly targeted marketing engine that reaches consumers directly in their homes.
They don't have to bid against competitors for ad space on Instagram to launch their Southern Tea line.
They just integrate the promotional content directly into a physical product that the consumer has already paid to receive and actively trusts.
They are using the relic of the legacy print business to completely bypass the digital customer acquisition tax.
Which is a structural advantage that a lean digital native startup just cannot replicate.
You can't simply wish a physical distribution network of 350 million touchpoints into existence.
It transforms their legacy print division from a dying liability into an incredibly powerful incubation engine for high-margin consumer products.
Okay, so let's examine how this philosophical shift translates into the actual Q4 financial data, because Wall Street judges execution based on the aggregate numbers.
Right. Here's where it gets really interesting. Their adjusted EBITDA for the year came in at $331 million.
That is their cash profit from operations, and it paints a picture of a company that is heavily cash flow positive despite the disruption to their core traffic.
The composition of that revenue growth is where we see the structural pivot manifesting. Advertising revenue grew by 9%.
And keep in mind, this is happening while their core web sessions dropped by 13%.
To achieve 9% revenue growth on 13% less traffic means they are commanding significantly higher yields for the inventory they do have.
That tells me the quality of the audience remains exceptionally high. Advertisers are paying a premium for brand association, not just raw clicks.
Performance marketing also grew by 17%. Christopher Halpin, the CFO, attributes this to a strong holiday period and consumer resilience.
But the most explosive growth metric in the entire report is the licensing division, which skyrocketed by 36%.
36%. That is the financial proof of the off-platform strategy right there.
Because that 36% is not coming from users visiting IAC's websites. It's driven by Apple News monetization, content syndication, and a massive new AI content partnership with Meta.
We have to unpack the mechanics of that Meta AI deal. It represents a complete shift in the power dynamic for publishers.
For years, AI companies just scraped the web indiscriminately, right? Pulling in content without permission or compensation to train their models.
Yeah, the publisher sued, the regulatory pressure mounted, and now we're finally seeing formal licensing agreements.
Meta is actively paying IAC for access to clean, verified, high-quality data to train their systems.
It's a transition from adversarial extraction to high-margin licensing. IAC is monetizing their historical archive without serving a single ad or hosting a single web session.
They are turning the threat of AI into a direct high-margin revenue stream. It's brilliant.
Now, looking at the full picture, the print division did decline by 23%.
Right, which the transcript is very clear was anticipated. It's the unavoidable secular decline of the print medium globally.
Management also notes that a portion of this decline, roughly $20 million, was a tough comparison to the prior year due to a drop-off in political advertising spending.
Right, political ad cycles are incredibly volatile. The money floods in during an election year and vanishes the next.
And that affects every media company's balance sheet, regardless of their political alignment. It's just the nature of the beast.
You have to isolate that cyclical noise from the underlying structural changes. And the defining structural metric provided by Neil Vogel is the non-session revenue.
Yes. 38% of their total digital revenue is now classified as non-session based.
Meaning nearly 40% of their digital income is generated without a user ever typing in a URL or clicking a link to visit one of their legacy websites.
And that specific non-session segment grew by 37% year over year. The off-platform views have nearly doubled in just 2 years.
With a massive 43% growth spike in Q4 alone, the strategy is unequivocally working.
But I want to understand the consumer psychology driving this. Like, why is the off-platform engagement accelerating so rapidly?
It really comes down to friction. The modern consumer expects the content to come to them.
Fully integrated into the environments where they already spend their time.
Exactly. The era of the destination website is fading. Users don't want to leave Instagram, TikTok, or Apple News to visit a secondary site.
They don't want to wait for it to load, navigate a new interface, deal with cookie pop-ups.
IAC recognized this behavioral shift. Instead of spending capital trying to force users back to their owned and operated websites, which is a losing battle, they re-architected their content.
They made it live natively within those external ecosystems, and they figured out the back-end mechanics to monetize it there.
Think about your own digital behavior for a moment. When was the last time you actively typed a publisher's web address into your browser?
Honestly, almost never. My media diet is curated by algorithms feeding me content within an app.
Right, so by abandoning the friction of the destination website, IAC is intercepting the user where their attention is already focused.
To truly understand how this non-session revenue operates, we have to look at the micro case studies Neil Vogel presents in the call.
These are granular examples of what they term grassroots monetization, and they highlight a profound cultural shift.
The first example is My Recipes. This is a digital recipe locker they launched less than a year prior to this earnings call.
And in that compressed time frame, it acquired 3 million registered users who actively saved 24 million recipes.
The critical detail Vogel highlights here is the total absence of a Google middleman.
The value of first-party data in 2025 cannot be overstated. When a user finds a recipe via Google search, they remain Google's customer.
They visit the site for 3 minutes, generate a fraction of a cent in ad revenue, and leave.
But when a user downloads the My Recipes app, registers an account, and curates a personal library of 24 million recipes, they become IAC's direct customer.
The company owns the email address, they own the behavioral data, and the communication channel.
They can monetize that user continuously through targeted advertising, subscription upsells, or commerce integrations without ever paying a toll to a search engine.
It fundamentally changes the lifetime value of the consumer. That brings us to the second case study, the mobile application for People magazine.
The engagement disparity between the traditional web and the app here is staggering.
On the legacy website, the average user session lasts roughly 2 minutes. On the mobile app, the baseline visit triples to 6 minutes.
But the real leverage comes from the introduction of interactive utility. They built People Puzzler games directly into the app.
And when a user engages with those games, the session duration explodes to 20 minutes.
Securing 20 minutes of continuous active attention on a mobile device is the holy grail of modern digital media.
It really is. It demonstrates the evolution from passive content consumption to active habit formation.
They took the traditional crossword puzzle and gamified it for the smartphone. A 20-minute session provides immense inventory for high CPM video ads.
It deepens brand loyalty and creates a daily active user metric that Wall Street values exponentially higher than a passing web click.
Which leads right into the third case study involving the legacy fashion brand InStyle.
They launched a social-first video franchise called The Intern. It's this mockumentary-style Gen Z-focused series starring their actual employees.
And it was originally shot entirely on iPhones.
Yet it has scaled to the point where it commands $500,000 to $700,000 in direct sponsorships per 6-episode season.
Which is incredible margins. But this is where you have to question the internal dynamics of a massive conglomerate.
Yeah, a 100-year-old holding company producing a viral TikTok series on an iPhone seems completely counter to corporate bureaucracy.
Usually a project like this would require a massive budget, agency oversight, and months of production meetings.
By which time the trend would be completely dead anyway.
Right. So the success of The Intern signifies a massive operational restructuring. Leadership is actively dismantling the heavy production processes that choke innovation.
By empowering their staff to experiment cheaply with mobile hardware and native social formats, they're behaving like a nimble creator economy startup.
Redeploying capital away from the dying text-heavy SEO content farm and into low-cost, high-margin video formats requires a cultural agility that is very rare.
It proves they're willing to cannibalize their legacy processes to find where the actual profit margins exist today.
But we have to remember IAC is not just a collection of digital publishers, it is a sprawling holding company.
Right, so to evaluate their overall health, we must examine the other pillars of their portfolio. The most significant of these is their massive position in MGM Resorts International.
The MGM megabet. This is the purest distillation of their overarching strategy to anchor digital capital in physical reality.
The scale of the investment is massive. IAC initially deployed roughly $1.3 billion to acquire MGM stock.
And through subsequent purchases, they have amassed approximately a 25% ownership stake in the entire casino empire.
At the time of this transcript, that initial investment has appreciated to a valuation of $2.2 billion.
That is a colossal unrealized gain on the balance sheet.
But surely a digital media conglomerate buying a quarter of a casino company is about more than just stock appreciation.
Oh, absolutely. What is the operational philosophy connecting digital publishing to slot machines?
It connects directly back to the concept of the ultimate defensive mode. Barry Diller is incredibly lucid on this point.
MGM controls roughly 40% of the premium real estate and infrastructure on the Las Vegas Strip.
That physical footprint is completely irreplaceable. The regulatory hurdles, capital requirements, the sheer scale of the engineering, it's impossible to disrupt.
You cannot digitize the kinetic energy of a crowded casino floor.
Wow.
You can't digitize the high-end culinary experiences or the physical luxury of the Bellagio.
It is the exact opposite of a digital article that can be replicated by an AI in milliseconds.
Furthermore, MGM is in the process of constructing a monumental $12 billion integrated gaming resort in Osaka, Japan.
Targeted for completion around 2029 or 2030. And the Japanese government is notoriously strict with gaming licenses.
Right. Acquiring one is an immense regulatory victory that guarantees a near monopoly in a highly lucrative market.
So IAC is taking the massive cash flows generated by the digital economy and aggressively anchoring them in hard, experiential, physical assets.
Assets that are entirely immune to technological disintermediation. It is a brilliant macroeconomic hedge.
But the portfolio does have areas of weakness, specifically the Care division, which houses platforms like Care.com.
Yeah, the Q4 numbers show overall revenue for this segment was down 9%.
Digging deeper, the enterprise side, where they sell care benefits as packages to large corporations, dropped by 13%. The consumer side also saw a 4% decline.
The Care division is currently navigating a severe macroeconomic headwind. As corporations tighten their budgets, employee benefit packages are often the first line items to be cut.
Especially supplemental care services. However, focusing solely on the top-line revenue decline misses the operational efficiency of the business.
That is a crucial distinction, because despite the revenue contraction, the Care division still generated $19 million in adjusted EBITDA.
They maintained a highly profitable 22% margin while the business was actively shrinking.
That margin preservation is a hallmark of disciplined management. CFO Chris Halpin details their strategy to manage through this cyclical downturn.
The business is still normalizing from the massive, unsustainable spike in demand for care services experienced during the pandemic lockdowns.
By optimizing their marketing spend and exercising ruthless cost control, they have protected the cash flow.
Management maintains a clear line of sight to returning to 15 to 20% growth once the macroeconomic environment stabilizes.
And once the post-pandemic churn fully washes out of the system.
Alongside the Care division, they have a segment of emerging businesses, which includes Vivian and the Daily Beast.
This portfolio provided a stark contrast, showing 18% overall growth and flipping from an operational loss to generating $3 million in positive EBITDA.
The Daily Beast alone recorded 50% growth.
And Vivian is a particularly compelling asset. It is a highly specialized digital marketplace designed to connect 2.7 million nurses and healthcare clinicians with staffing agencies.
The healthcare staffing market is incredibly complex and heavily regulated. Vivian essentially acts as the liquidity provider in that market.
Under the leadership of their new CEO, Bill Kong, who transitioned into the role from the founder, the platform has successfully reaccelerated its growth trajectory.
It represents a highly defensible niche utility that is deeply embedded in the healthcare supply chain.
Finally, we have to look at the AMG segment, which handles their legacy search business.
The language management uses to describe this division is remarkably blunt. Halpin explicitly states that AMG is managed purely for margin extraction, not for growth.
AMG is essentially a financial artifact. It represents the old architecture of the internet, where businesses acted as intermediaries for desktop search queries.
It has not been a strategic priority for years, and its footprint is steadily compressing.
The vulnerability of that model is laid bare in the transcript. They disclose that the entire future viability of the AMG division hinges on active negotiations with Google.
They state they will have absolute clarity on the fate of this business within the next 90 days, based entirely on whether Google decides to extend their partnership agreement.
It is the ultimate cautionary tale. And it's the exact reason why Diller and Vogel are aggressively pivoting the rest of the conglomerate.
AMG is what happens when a business remains entirely tethered to a single dominant platform. The platform holds all the leverage.
IAC is methodically extracting whatever cash flow remains in the AMG model, but they harbor no illusions about its terminal trajectory.
This transition away from legacy models requires a fundamental change in how the company communicates its performance to the market.
Which brings us to the financial engineering, the litigation, and a major policy shift regarding Wall Street.
Yeah, management dropped a significant operational curveball in this call. They are officially terminating the practice of providing quarterly financial guidance to analysts.
No more 90-day revenue or earnings predictions. In the ecosystem of public markets, eliminating quarterly guidance is often interpreted as a major red flag.
Because analysts rely on those 90-day benchmarks to model their valuations. When a company suddenly stops providing them, the immediate assumption is bad news.
Analysts think management is attempting to obscure deteriorating financials.
But the context of IAC's massive structural pivot changes the calculus entirely. If Neil Vogel is forced to hit arbitrary revenue targets every 90 days, the incentive structure becomes toxic.
A CEO under that pressure might cancel the funding for the My Recipes app or delay the launch of the Southern Tea physical product just to squeeze out a few more cents of EPS for one specific quarter.
Halpin refers to that short-term optimization as a long walk for a short drink. Obsessing over quarterly increments destroys long-term enterprise value.
By shifting to an annual guidance framework, they are forecasting mid to high single-digit digital revenue, and EBITDA growth for PeopleLink for the full-year management is creating breathing room.
They are communicating to the market that they must be evaluated on the fundamental architecture they are building, not on superficial quarterly fluctuations.
And following that structural change, there is a highly unusual line item in their forward-looking expenses.
They are budgeting $15 million this year strictly for litigation against Google. This is an enormous sum dedicated entirely to legal fees.
And this is not a defensive posture regarding a patent dispute or a minor regulatory infraction. This is a highly calculated, aggressive antitrust maneuver.
The mechanics of the digital ad market are crucial here. For years, Google has effectively controlled every node of the digital advertising transaction.
They represent the publisher selling the ad space, they represent the advertiser buying the ad space, and they own the exchange where the transaction occurs.
IAC's litigation is built upon previous government rulings and Department of Justice investigations, which found that Google utilized this monopoly power to artificially suppress the revenue yields for publishers.
Management does not view this $15 million as a sunken legal cost. They view it as a high-yield investment.
They are aggressively pursuing damages based on the premise that Google's monopolistic practices directly siphoned hundreds of millions of dollars in potential revenue from IAC's properties over the last decade.
If they spend $15 million now to secure a settlement or a judicial ruling worth $300 million in the future, the return on invested capital is astronomical.
It is a high-stakes legal strategy designed to claw back historical losses. While they are deploying capital for litigation and physical product expansion, they are also executing a massive financial engineering play.
To reward their current shareholders.
Over the trailing 12 months, IAC repurchased $337 million of its own stock. Through these buybacks, they have permanently retired a massive 10% of the company's total outstanding shares.
The strategic intent behind retiring 10% of the float is to rapidly concentrate the value of the enterprise for the remaining shareholders.
When a company reduces its share count by such a significant margin, every remaining share represents a larger proportional ownership of the underlying assets and future cash flows.
Barry Diller explicitly argues that the public market is fundamentally mispricing the company, specifically by ignoring the massive unrealized value of their 25% stake in MGM Resorts.
By aggressively buying back stock at what they perceive to be a steep discount, they are executing a highly tax-efficient transfer of wealth to their long-term investors.
Additionally, their projection of a 50% plus free cash flow conversion rate for 2026 indicates they will have the continued liquidity to maintain this aggressive capital allocation strategy.
So if you're an investor trying to figure out the bottom line here, we have dissected a massive amount of corporate strategy, financial data, and market philosophy today.
We began with the stark reality of a 50% collapse in traditional search traffic, an event that would normally signal the death spiral of a digital publisher.
But beneath that headline, we uncovered a masterclass in corporate survival and adaptation.
We are watching a legacy conglomerate utilize the massive cash flow generated by its historical assets, the legacy care divisions, the shrinking search business, and the massive print magazine distribution network to finance a radical AI-proof future.
They are abandoning the dying SEO-dependent web. They are leveraging their cultural authority to build tangible physical products, deep direct-to-consumer mobile applications, viral original video franchises, and massive, irreplaceable real-world luxury infrastructure.
The overarching lesson encoded in this earnings call is that raw information is no longer a defensible business model. Generative AI has commoditized the written word and the basic dissemination of facts.
The ultimate moats in the modern economy are verified knowledge, entrenched brand authority, and physical friction.
The algorithms that govern digital distribution will continue to change, but the consumer trust required to build a lifestyle brand takes decades to establish.
An artificial intelligence model, regardless of its processing power or parameter count, will never possess the cultural resonance required to dictate fashion trends.
Nor will it ever possess the physical engineering required to host thousands of people on the Las Vegas Strip.
By aggressively shifting their capital and their operational focus into the physical, experiential, and directly owned audience spheres, IAC is systematically rendering the threat of AI disintermediation irrelevant to their core enterprise value.
Which is a remarkably bullish signal for a company that just lost half its core traffic.
This evolution leaves us with a profound question about the future identity of these corporations. If a digital media company's ultimate defense mechanism against an AI-generated internet is to begin manufacturing physical beverages, constructing luxury integrated resorts in Japan, and producing independent sitcoms starring their own staff,
Wait.
at what precise point do they cease to be a media company entirely? Are we witnessing the slow death of digital publishing, or are we simply watching its necessary evolution into a diversified, real-world lifestyle conglomerate? Let that steep for a bit. Thank you for taking the time to join us on this deep dive into the mechanics of disruption. Keep analyzing the structures behind the headlines, keep looking for the signal in the noise, and we will see you next time.